I'm going to compare a Wendy's property, okay, that has a base rent that's paid from the tenant to the owner of $125,000 annually. Okay, I'm going to compare that to a small multifamily that also is bringing in $125,000 of gross collected rents from the tenant. Pretty small multifamily, just to make as close to apples of a comparison as possible. So when you look at the multifamily property, that $125,000 of gross collected rent, that comes with a whole slew of expenses, right? So you've got things like property management. You've got things like, your vacancy, evictions. You've got things like, your office staff or your on-site manager. You've got things like mowing the lawn and sweeping the parking lot and plowing the snow and fixing the roof. And paying the taxes, paying for the insurance, all those different things, boiler leaks, issues with anything, landscaping, et cetera, et cetera. So at the end of the day, that $125,000 is going to be offset by maybe let's call it 50% of expenses. You could have $60,000 or $65,000 of expenses easily. Now go back to that Wendy's that's bringing in $125,000 of base rent. Well, in the Wendy's example, believe it or not, but the tenant pays for your taxes, the tenant pays for your insurance, the tenant pays for all common area maintenance. They pay to plow the snow, they pay to manage the property, they pay to fix the roof, they pay to cut the grass. Every single thing there is, they're paying for it. So the reason it's called a net lease is because the rent that you receive is net to you. The $125,000 gross collected rent is $125,000 net operating income, right? So the property that I just described is what's called an absolute triple net property.
Welcome to the Cashflow Fight Club podcast. In the Champions Corner edition, I'm Mike Deaton, and together with Lydia, my co-host in life, business, and this podcast, we're taking you into the training room, deep in the dojo, sharing the secrets of what it takes to forge a champion. We're digging deep into mindset mastery, high-performance habits, best-in-class behaviors, and bringing you the tips and techniques that maximize human potential, brought to you from some of the best in the business.
So grab your buds and your seat. Hit subscribe and get ready to up your game. Let's do the show.
Let's do it. Triple net leasing. Heard of it? And if you have, do you know anything about it? Or just how powerful of an investment class it can be? Well, in the Champions Corner today, we have the pleasure of learning from an amazing force in commercial real estate, Dan Lewkowicz. Dan's a man of many talents and has a diverse background, ranging from that of a business development exec at Amazon, to an early house hacker who graduated into flipping, and then to a large-scale enterprise that acquires, finances, renovates, and sells single-family properties in the Detroit, Michigan area. Well, currently, Dan's Senior Director of Encore Real Estate Investment Services and specializes in shopping centers, medical office buildings, pharmacies, quick service restaurants, automotive repair and parts stores, as well as resorts. And today, he's sharing his experience and expertise with triple net leasing and how it can amplify your investment portfolio in a way unlike other real estate investments. Let's jump into the Champions Corner with Dan Lewkowicz. All right. Welcome, Dan. Thanks for joining the show and coming on and telling us all about net leasing today.
Yeah, my pleasure. Thank you so much for having me.
Yeah, you bet. So net leasing, man, like we were talking about, I'm familiar with it at a service level, but just not really with any depth, or I haven't explored it. So I'm excited to dig into the topic and hear a little bit about how it can help investors and active real estate participants out in 2024.
Yeah, absolutely.
But maybe before we dive into that, tell us a little bit about yourself, some of your personal background, what brought you to where you are today, and all of that good stuff.
Yeah, absolutely. So thanks again for having me. My name is Dan Lewkowicz. I'm the Senior Director here at Encore Real Estate Investment Services. We're a boutique net lease investment sales firm. So I help buyers and sellers transact on net lease property all over the country. I focus mostly on single tenant net lease, but I also do a tremendous amount of activity in the multi-tenant shopping center space. So we sell a lot of pharmacies like Walgreens and CVS's, a lot of fast foods like Wendy's, Taco Bell, KFC, do a lot of medical office buildings, as well as, like I mentioned, shopping centers, some industrial as well, discount retailers like, dollar stores, a lot of automotive parts stores like, AutoZone or Discount Tire or Tire Kingdom, things like that. So yeah, I mean, that is essentially what I do. I got my start in real estate quite some time ago, back in 2005, actually. I helped to start a company called Disability Made Easy, which is a barrier-free home modification company that essentially modifies homes to make them handicap accessible. And through my time at that company, I really kind of had, emblazoned in my mind this idea that you could take something that was maybe functionally obsolete or that needed some changes, and then do those changes. And at the end, you have something that has greater functionality, greater usefulness, a lot more value in it. So that really, kind of got me kickstarted into my career flipping houses, which I did for a number of years in a number of cities. Had a lot of great experiences. I mean, tons of stories I could share at appropriate times. And eventually, as I was doing that, I was also working in corporate America as a business development executive at Amazon, amongst other places. And eventually I went out on my own, full-time house flipping, and then transitioned into where I am now, which is, net lease investment sales brokerage. I still do flip houses from time to time to kind of scratch that itch, but really the vast majority of my time and effort is focused exclusively on net lease investment sales brokerage.
All right. Wow. Man of many hats. I like it. I'm also a guy who likes to kind of explore a breadth of topics. Are you, in your flips, are you swinging a hammer or?
No, I mean, thankfully, no. If I was swinging a hammer, not only would they never get done, but, who knows where, what would be nailed to what. But no, from the beginning, I was more of a, hey, I want to learn how to do it. I want to assist you. In the beginning, I learned every trade myself by supporting the people that were working for me. But, especially when you're at scale, flipping 5 or 6 houses at a time, you just can't be the guy that's, sourcing the capital, finding the deals, closing the deals, swinging the hammer, selling the deal. It's just too much. So no, thankfully that wasn't an aspect of the business that I was, very involved in. And as the years went on, I went from managing my own crews, which I, affectionately called adult daycare, to essentially contracting out with a general contractor just so that I could be, as few visits to the property as possible.
Nice. Yeah, my dad was a general contractor back in the 80s, and I grew up learning all the trades. So I would spend summers, and if there wasn't sports going on, it was sometime after high school as well, where I was cleaning out houses, mowing yards, roofing, framing, whatever, you name it. So sure. I have an affinity for some of that stuff.
And reading your bio, you are a dad of 5 kids, 5 lovely children. I am a dad of 5 kids. So I would imagine that you have to choose what you stay involved in and what you're not, so you can be present for your family as well.
Oh, yeah, absolutely. My kids were always involved in the house flips, picking out colors and taking them to the site and, just discuss. I talk a lot of real estate with my kids, obviously, because I love it. And, they enjoy talking about it as well. So, yeah, I mean, it's definitely a balance. And a lot of what I do is because of them. It's for them. It's ultimately, I want to be a provider and I want to build something that one day if my kids are at that stage in life where they want to come and take over what I'm doing, I would, there's nothing that would make me happier. So yeah, definitely a balance.
What are the ages? What's your oldest? Do you have anybody that's even on the precipice of that level?
Yeah. Well, my oldest is almost 15, believe it or not. So I've got almost 15. My youngest, my next daughter, I apologize, is turning 12 on Christmas Eve. And then I've got 10, 7, and I have a 15-month-old.
Okay, so you got the spread, 15 to 15.
So there you go. Exactly.
That's awesome. Yeah. I grew up in a big family. We were 5 kids as well, and it was just wonderful.
That's great. Yeah, it's a good thing. Very thankful.
Yes.
Well, let's dive into net leasing and the world of that. You touched on some of the questions that I had in your intro. But yeah, I mean, I guess starting out, just maybe give us the 50,000 foot view of net leasing. I know like I said, you've touched on a little bit about it, but just to explain, the ins and outs, how that works, and then we can drill into some more detailed topics.
Absolutely. I like to describe what net lease is by kind of comparing it to another asset class, a familiar asset class, and showing what it isn't to really highlight those nuances and differences. And the asset class that I compare it to is multifamily. So for the purposes of this example, I'm going to compare a Wendy's property, okay, that has a base rent that's paid from the tenant to the owner of $125,000 annually. Okay, I'm going to compare that to a small multifamily that also is bringing in $125,000 of gross collected rents from the tenant. Pretty small multifamily, just to make as close to apples of a comparison as possible. So when you look at the multifamily property, that $125,000 of gross collected rent, that comes with a whole slew of expenses, right? So you've got things like property management. You've got things like, your vacancy, evictions. You've got things like, your office staff or your on-site manager. You've got things like mowing the lawn and sweeping the parking lot and plowing the snow and fixing the roof. And paying the taxes, paying for the insurance, all those different things, boiler leaks, issues with anything, landscaping, et cetera, et cetera. So at the end of the day, that $125,000 is going to be offset by maybe let's call it 50% of expenses. You could have $60,000 or $65,000 of expenses easily. Now go back to that Wendy's that's bringing in $125,000 of base rent. Well, in the Wendy's example, believe it or not, but the tenant pays for your taxes. The tenant pays for your insurance. The tenant pays for all common area maintenance. They pay to plow the snow. They pay to manage the property. They pay to fix the roof. They pay to cut the grass. Every single thing there is, they're paying for it. So the reason it's called a net lease is because the rent that you receive is net to you. The $125,000 gross collected rent is $125,000 net operating income, right? So the property that I just described is what's called an absolute triple net property. And I'll explain what that means of triple net. So the first net is taxes and insurance. That's the first N. So in our example, the Wendy's tenant is paying for the taxes and insurance. The next is going to be any kind of common area maintenance with the building or maintenance around the building. Wendy's is paying for that. And the final N is going to be your roof, structure, and parking. Okay? So Wendy's is paying for that. Now, as a little bit of a digression, there are other forms of net lease that are maybe what's called a double net lease. This is common in pharmacy or in dollar stores, for example. Not all dollar stores and not all pharmacies are double net. Some are triple net or absolute triple net, like I said. But in a double net lease, the tenant still pays for taxes and insurance, the first end. They pay for all common area maintenance. And what they do not pay for is roof and structure and sometimes parking. So in those examples, we advise our clients that they should hold a certain replacement reserve from what they collect in reserve so that when they need a new roof every, let's call it 20 years, they're not going to have a huge amount of money out of pocket. So in general, that's what net lease is. There's other types of lease called like a gross modified lease that we deal with sometimes where the tenant is not responsible for many of those other things. But in general, the gold standard is that absolute triple net lease, right, where the tenant is paying for everything. Now, as another aside, I just want to make mention, when you drive down the freeway and you see a Wendy's, you might drive down the freeway another 5 miles and see a Wendy's. They might look exactly the same, but those two properties could be very different, okay? This is important to notice in net lease because, number one of those properties might be operated by a small mom and pop, operation that has 4 or 5 Wendy's, and the lease is signed by that corporation, and it's backed by those 4 or 5, locations. Down the road, you might have another Wendy's that's backed by a huge corporation that has 300 or 400 locations, right? So that's very important to note that there are other factors that make certain properties more appealing than others. And obviously things like the remaining lease term, the amount of rent that's being paid, as well as the tenant sales at the location and what the rent to sales ratio is. Those are all important factors when deciding which net lease property might be for you.
Got it. So it sounds like it really just boils down to negotiation, right? The who has the leverage or who negotiates the terms as to how much and what is all covered in the leasing agreement.
I mean, to a certain extent, yes. And, just to clarify, I deal pretty much exclusively with investment sales, which means I'm selling the building, right, that has the lease associated with it, that has the tenant associated with it. If it's occupied, I do some leasing, but it's not my specialty. And, as it pertains to the leases themselves, in general, each specific tenant is going to have a pretty boilerplate understanding of what kind of lease they're going to get. In the quick service restaurant or the fast food space, for example, it's like, I don't think I've ever seen anything other than an absolute triple net lease. In the pharmacy space, mostly double net, some absolute triple net. Same thing with the dollar store space. So there's not a ton of room for leverage, especially when you're dealing with the big corporations. But I wrote an article today about a certain concept where landlord and tenant will often negotiate at the end of a term to renew the lease, and they'll do what's called a blend and extend, where the landlord says, "Hey, I'm willing to lower the rent in exchange for you, Mr. or Mrs. Tenant, to give me a longer term lease. So yeah, there is negotiation that is done, at times of lease renewal or when the leases are cast initially.
Okay, but then it sounds like it's a little more defined by the industry or the type of tenant in terms of like all fast food franchise typically lease under a similar agreement or arrangement. And then as me, I guess if I was working with you, I would be buying the building and inheriting whatever active leases there are in a shopping center or a structure or whatever. Is that kind of how it works?
And just like if you buy a single family residential home or a multifamily building, you're beholden to those leases. You can't just come in and say, hey, I don't like you guys anymore, get out. You're beholden to them. All you're doing is stepping in the place of the previous lessor and assuming that lease when you're buying the building.
Okay, got it. That makes sense. Clear?
Not yet. I'm still listening. I'm still digesting what I'm hearing.
All right. Well, then maybe we summarize. So, City Market down in town.
Yeah.
They're in part of a strip center, right? There's a mail center, a strip market, a nail salon, all that kind of stuff. Well, they pay leases to an owner.
Yes.
And so Dan, I guess, he would sell the strip center.
Mm-hmm.
And if you or I were interested and maybe we had a syndication or we just have a big bank, we would buy it and we would inherit all those tenants. And their leases vary from some expire in 2024, some might expire in 2034.
Right.
We just roll with it. But
thank you for
we become the landlord of all those.
Yes.
So,
are you partnering with any owners?
Myself personally to buy the properties?
Yes.
It's not, honestly, that's a touchy subject in the brokerage world because, obviously we want to first and foremost serve the interests of our clients. And, without obviously full disclosure would need to be made so that, an owner knows, hey, I'm part of a buying entity. But no, I mean, I do invest, aside from my day-to-day line of work. For example, I've actually very, very happy to have invested with some longtime friends recently, just a week or two ago, in a build-to-suit Starbucks joint venture where essentially I'm lending money to the person that's doing the build-to-suit. That's very exciting to me. But, typically I try to, keep a clear line and clean line. Otherwise, I personally believe that, if I'm involved in the brokerage side and in the purchasing entity side, it just becomes very blurrious. Like, who am I serving? What is my role? This way I can say without question, 100% of the time, my role is as a broker, and my role is to do what's in the best interest of my clients.
Yeah, makes sense.
Yes.
So you've piqued our interest, and Lygia and I are interested in, and it sounds like dollar for dollar, there's less headache and hassle than multifamily that we're involved in. So how does one go about playing in this investment space? What types of investors do you see coming, and kind of what's the range there?
Yeah, so I mean, listen, I talk to a lot of people about this because it is, definitely a topic of interest in terms of people who are getting involved in net lease. Maybe some of them don't have investing experience in commercial. Maybe some of them have investing in another asset class like multifamily. But, the first thing is going to be to forge broker relationships. At the end of the day, the best deals get done with a broker's inner circle. So you want to be part of that inner circle. And I always tell people, like, listen, if you want to, talk about deals, you want to analyze deals, you want me to look for deals for you. If you're not a buyer, I've got no problem with that. I love education, right? But I need clear expectations from the front. I need to know, essentially, are you, a serious buyer, or are you someone that's learning? And there's no shame in the latter. There's no shame in either. And also, if you are a buyer, we need to set out, what are your check marks that need to go into those boxes, right? That if I give you a property that checks every single one of these boxes, there should be no reason that you're not making an offer and purchasing, right? Because if I start doing that too many times, I'm going to start wondering, wait a minute, are they really, in a position right now to be a legit buyer? And I only want to know that to be respectful for my time, your time, and the time of the individual that's selling the property and that broker as well. It's very important. So I would say, just like anything, I look at it like buying a home, right? I remember when I went to buy, the home that I live in now, it's a different neighborhood than I lived in before. And, my wife and I went to a property and we're like, oh, we love this property. This is amazing. Like everything about it is perfect, right? New neighborhood, new style of homes, but everything was perfect about this first house. So I sat back, I said to myself and to her, I said, listen, let's look at another house. We can always come back to this one. Let's look at another house and see what we're missing. Go to the other house. We say, oh man, we want, an attached garage. We want an attic. We want a finished basement. We want a second kitchen, like all these things that we didn't think about. Same thing is true with commercial real estate. If you look at one deal and fall in love, it's not the deal for you. It just isn't, right? Don't look at one deal. Don't look at 10 deals. Look at 100 deals, okay? Because when you look at 100 deals, you're flexing those muscles. You're picking up on little nuances in the deal that you wouldn't have seen had you only looked at a few deals. And also, put those deals in front of somebody like me. Even if they're not my deals, come to me, say, Dan, I want to know, what's your take on this deal? Have a few different set of eyes to help you refine your microscope to know what you want and what you don't want. It's so important. I've seen, new buyers do it over and over where they see one deal, another deal, another deal. By the time they've seen 15 deals, they're like, oh, Dan, now I finally understand what I even want. So that's so important to do. I can't stress that enough. And, just be educated, know what you're getting into. Go in with your eyes wide open, because there are risks in this industry, in this niche, just like there are in any niche, in any industry. And, I'll be honest and forthright about them, but, have your eyes wide open to those as well.
Yeah, great advice. I mean, like I said, we've been in multifamily, we've been in a few other real estate ventures, and certainly you definitely want to exercise the muscle. And a lot of times you don't know what you don't know. And so, leaning on experts like you and brokers and mentors and people that are experienced is invaluable, because I can only imagine the size of these deals is not something that you want to make a mistake on, or, stub your toe. It can be painful.
Absolutely.
So who are you seeing? I imagine there's a breadth of buyers out there, ranging from individuals to partnerships to corporations or companies. Is that kind of typically what you see in the space? And I think we talked earlier also about, syndication opportunities. You see things like that, or just, what's your typical buyer profile?
Absolutely. I mean, it varies, right? So the buyer profile can be anywhere from an individual that's using his own capital or her own capital, a family that's using their capital, someone that owns 1 to 10 properties. It can be a fund. I just recorded some educational content yesterday with one of my clients. He has a fund. All they do is buy shopping centers. So he raises capital, buys shopping centers, deploys the capital, right? So they can be, real estate investment trusts. I mean, here's one local Agree Realty. I sold them a Tire Kingdom in South Florida. They can be big players, dealing with institutional capital. Oftentimes when the market gets difficult, they're the only buyers, and that's when they're able to clean up and buy things at tremendous discounts. Family offices, syndications, absolutely. I mean, I think it's becoming more and more common, especially in the multi-tenant space, in the shopping center space, because the cap rates are typically higher, so it makes sense. It's hard to syndicate a four cap, Chick-fil-A, right? It's a lot easier to syndicate a 9 cap shopping center. But it really, can range all across the board. And, a lot of times I'm dealing with individuals. A lot of times I'm dealing with committees. So, it really varies.
Yeah. Yeah, it makes sense. I mean, it's just a real estate asset class that sounds like it's pretty approachable as long as you're capitalized. How are you touched on the market a little bit. That was something that I'm curious about. So I think for the last few years, we've all been hearing about office is dead. And, I don't know that bled into shopping centers so much, but how is the market, other than I know it's, as with anything, it's local and sub-market dependent. But in general, are things depressed right now and there's opportunities, or are things pretty good? And we're recording this here right at the end of 2023.
Yeah. So it's interesting because, for me in the net lease space, the actual geographic location is not nearly as important as it is with other types of asset classes, because I'm really, I'm selling a building in general that's really a bond, right? The lease that's wrapped up in sticks and bricks. So the terms of the lease, the credit of the lessee, right? The rent, all of those factors are very important. Yeah. Do I want to see a property that has high traffic counts and great ingress and egress? Absolutely. Is it important that it has great demographics as well? Yes, it is important, depending on the type of asset, but there are other factors that are probably more important. I do have a lot of buyers that, they don't buy in submarkets. They only buy in major metropolitan statistical areas. They only buy if the 5-mile population is, 125,000 or higher, for example. So yes, to kind of just hone in on part of your question, Real estate in general is hyper local, but net lease is less so than other asset classes. In general, from a national perspective, how is the market? I mean, listen, we had the Federal Reserve, increase interest rates. The federal funds rate went up by approximately, 550 basis points over about 17 months. So that's going to put a damper in any market that is, highly tied to leverage, right? Which ours is. But what's fascinating is that in the net lease space, you would think, okay, interest rates go up 550 basis points, 5.5%. Well, most investors who are leveraging, they're looking specifically for a spread between what they can borrow at and what they can buy at, right? So,
Right.
A couple of years ago when you could borrow at 3%, if I'm buying at 5%, great, 200 basis points of spread, maybe 5.25, 225 basis points of spread. Life is good. Well, imagine if that 3% goes to, we saw it go all the way up to probably about 7.5, maybe 7.75, which is like earth shattering for us. But cap rates in most of the subclasses within net lease barely rose more than 75 basis points, right? Dollar stores rose 100 basis points, 125 basis points, because they were the ones that had compressed the fastest, probably. So that was the anomaly. Quick service restaurant, 50 to 75 basis points. So your borrowing rate is going, your federal funds rate, I should say, is 550 basis points higher, but your cap rate is 50, 75, 100 basis points higher. It didn't make much sense, but it does go to show you the relative stability of net lease and the stickiness of the cap rates. They don't move up that quickly, even in what many would have viewed as a catastrophic time. Now, what I think is great is that the market has been relatively healthy, although transactional volume has definitely gone down. Thankfully, myself, my team, this has been a great year, not as great as the last few, but much better than it could have been. But across the board, brokerages have been hurting and have been down. But I think that all in all, we've really weathered this storm. And the Fed, with their last two pauses on hiking rates, have signaled, and Jerome Powell has said outright, language that have made people believe that in 2024 we might see 3, 4, 5 interest rate decreases. So I think that if the market was able to continue and have its robustness, if we were able to have this very hot labor market, low unemployment, if we have, this is kind of whole nother topic, but if inflation is under control, as those in power say it is, which I don't really believe, but that's another story, right? So if all those forces are in play, and now all of a sudden we start reducing interest rates, I think 2024 is going to be a banner year. I really do. There's a lot of capital on the sidelines that's waiting to get back in the game.
Yeah, so true. 2023 was, in for all intents and purposes, a wait and see year, and it's finally feels like it's on the cusp. And the at least the indications coming out, as you said, are at worst case they'll hold steady, but looks like the optimum or the go forward solution will be a few cuts on the way, and so should help things out.
Yeah,
sure.
One last point I think people talk about a lot is that our country and our government can't afford to keep interest rates relatively elevated like this, because our debt service on our trillions and trillions of dollars of national debt is just unsustainable unless rates are lowered. So I do believe that's going to be a huge factor, in 2024 in terms of lowering rates.
Yeah, it's a good point. It's a very valid pressure that's on the Federal Reserve to make those moves. Yeah, definitely. Speaking of federal institutions, what are the tax implications like on a property like this? Do you enjoy depreciable benefits the same as other asset classes?
Yes, and in many cases even greater. So in general, all the properties that we sell are going to have depreciation benefits, with really one exception. So just as a little aside here, in general, the way that it works with depreciation is that when you buy a building, right, it's typically you're buying a building and you're buying land. So real estate is depreciable, land is not, okay?
Sure.
So in certain cases, you have what's called a ground lease, where you don't actually own the building. You actually only own the land. And let's say, for example, Walgreens built this building here. A lot of security in owning this land, because Walgreens built the building. They're probably not going to walk away unless they absolutely have to. A lot of security. So there's something valuable there. But from a depreciation perspective, you can't depreciate the ground and you don't own the building. So we don't have anything more to talk about there. Now, there's another even more obscure type of lease that we don't come across very often. It's called a leasehold. So in this case, you don't own the ground. You only own the building. So, for example, Family Dollar rents from you. They rent space in your building that you own, but you don't own the ground. You have to now pay the ground holder that ground lease. So you're kind of sandwiched in between the tenant and the ground by owning just the building. Now, the cool thing about a leasehold is that guess what? It's 100% building, no land, which means now you can depreciate the entire amount. So there's an advantage there. Now, the other thing that I was alluding to a minute ago when I said that it is depreciable like other asset classes, but it has some advantages. There are certain things like car washes and convenience what do you call them? Gas stations, convenience stores that qualify for bonus depreciation. And we've seen some changes in bonus depreciation over this last year. Used to be that you could have 100% bonus depreciation in year one if your property was placed into service before, before 2023. Now, a property placed into service in 2023 has 80% bonus depreciation. Next year, 2024, will be 60%. It's going to go down, and then we're going to have some governmental changes, and they're going to reinstitute it back, I think. But we'll see. But the point is, there's some major advantages to owning real estate that has bonus depreciation or accelerated depreciation that's eligible that other types of asset classes are not. So definitely a big part of the tax strategy for people who own this type of real estate.
Okay, so great benefits there. Let's talk a little bit about how someone goes about evaluating these deals. What are kind of some of the key factors that we should look for? You've talked about cap rates a little bit, similar to a multifamily where you have net operating income. I assume the net lease is similar about how much income something's bringing in. What are those factors?
Yeah, so I would just tell them to that a broker evaluates property like this. So I can tell you exactly how I do that. When I look at a property, the first thing I'm going to do is go through the lease, or someone on my team's going to go through the lease. We're going to look at things like, who is the guarantor? How many units do they operate? How big are they? What's the likelihood that they're going to file bankruptcy and this lease is going to be worthless, right? I'm going to look at, do I have sales reporting? Do I know how well they're doing at this location? What's their rent? Is their rent in line with what is just in general, the likelihood that this property is going to, have success? And if I need to re-tenant it, what's the likelihood of me being able to easily replace my current rental income? So all those things are going to, come into play. And then I'm going to kind of assign a cap rate to the property based on, where each one of those unique variables falls on the scale, so that I can see, what is this property really worth?
Okay, interesting. So all of that's going into your cap rate assessment.
Absolutely.
Sounds like. Okay. And you touched on, I think you may have even covered all of them, but risk factors. What are there anything else other than, tenants and how deep rooted they are and other factors like that you guys typically look for?
Yeah. So we have this CBS. We got it under contract, getting ready to close. Again, absolute triple net lease. Landlord never has to do anything. Landlord is pretty local, but never hasn't been in the property in 20 years. So the buyer gets an inspection and it comes back on this absolute triple net property with $275,000 in required repairs to the roof, the parking lot, the stucco, all kinds of things. And unfortunately, this owner had to give a concession in order to close the deal. But had he done what I had mentioned and gotten that property condition report a year ago, 2 years ago, he could have sent a letter, or his attorney could have sent a letter to CBS says, hey, this is an absolute triple net lease. You are responsible for everything. Per this report, you are in default. You have 30 days to cure. End of story. And CBS, very high likelihood, would have done it. So that's advice I give to my owners, especially, even if it's an absolute triple net deal. That's important to keep in mind because you can lose a lot of money at the end of the day with that deferred maintenance, especially if the tenant leaves and then you're stuck. So I just tell my clients, be on top of it. It's surprising every day something comes up where I've got a client that's like, Dan, such and such happened. We didn't even know. We don't do anything with this property. We just set it and forget it. So I tell people to be a little bit more vigilant than that. In terms of additional risk factors, there's not really a lot. I mean, bankruptcy is a factor, but we do hear about it because it's newsworthy. It doesn't happen very often, but it's definitely something to consider. And that's why you want a guarantee that's as strong as possible.
Yeah, makes sense. Let's talk bottom line a little bit. So we'll circle back to an example you gave at the beginning of the podcast, 125,000 a year coming in net. What's the take home on that? So I'm assuming debt servicing then comes out if you have debt on the property, and maybe some unexpected expenses like you mentioned there that the tenant either isn't liable for or won't pay or something like that. But are there other things that come out of the the bottom line?
So it's going to depend on the asset. So like if you look at the most, I guess, landlord intensive of assets in my world, that's the shopping center. Shopping center is going to have management fee. It's going to have taxes. It's going to have insurance. It's going to have like common area maintenance things like the lights in the parking lot and mowing the grass and shoveling the snow. However, many shopping center leases, and I advise all my clients to do this, are what we call triple net leases. So they say they have different clauses, and in multi-tenant, as much as I told you that in single tenant it's very boilerplate, in multi-tenant it's very much not boilerplate. There's not a lot of standardization. So in multi-tenant, there's a lot of different ways you can kind of skin the cat. But in many cases with these triple net leases, what happens is there's a certain what we call CAM charge, common area maintenance charge. So for example, the tenant might be paying $15 a foot for the rent, and then $4.75 a foot for the CAM charges. And now those CAM charges are essentially going to be a reconciliation of every single expense of the center that's then broken down on a pro rata share and passed along to each tenant. By the way, in many leases, it says if those expenses go up, the landlord can reconcile and your CAM charges can go up. I always want my landlords to have as minimal or no expenses as possible. So I tell them to put language in their leases like that. But in those cases, you're going to be paying those expenses and then you're going to be reimbursed by the tenants. Okay. Now, in a gross lease, if any of your shopping center leases are gross leases, you're going to pay those expenses and not be reimbursed. If we kind of move along the spectrum to the double net leases I had talked about earlier, in those cases, a roof on a typical property like this is a flat roof, costs today about $7-8 a foot to replace, and they last 20, 25 years. So you're not going to be doing that very often. You might be, sending somebody up there every year or two to look at it and make the small repairs, which I highly recommend, right? Structural repairs are few and far between. If you have parking lot repairs, most owners will stripe and seal their parking lot every 2 years. They might have to do some repairs every few years and replacement, typically not for 10, 15, 20 years. So those are going to be expenses. In your absolute triple net building, you should have zero expenses, nothing whatsoever. Your CPA is going to be your expense, right? The guy or gal that's going to tell you how to get the most appreciation, that's going to be your expense. It's going to be 100% hands-off, 100% passive. Again, my advice, get a property condition report every year or two. It's one phone call or one email just to protect yourself. But in general, there's really not going to be any expenses that you have to worry about whatsoever.
Nice.
I have a couple of questions from an owner's perspective. What do you see? Are those properties bought in a syndication style? Like investors can come in and have a stake in the deal?
More common in shopping centers because just simply cap rates in shopping centers are typically higher, 7, 8, 9 cap and above. Like you said, if it's a Chick-fil-A at a 4% cap, it's hard to be an operator and, figure out how to run the deal and give your return to your investors. There are others that, in a certain sense, are buying a huge portfolio of single tenant net lease deals and syndicating them. But as I said, it is more common in the multi-tenant space.
Mm-hmm. And what is the life cycle? How many years approximately they hold the properties?
You're saying for most owners, how long do they typically hold the properties? It varies, but there are a lot of owners. As a broker, I almost wish this wasn't true, but there are a lot of owners that hold them for generations, right? They don't ever sell. And they, but there are others that say, I want a 1031 and keep going. And then when I, pass away, I'm going to do a stepped up tax basis. But you have on the other end of the spectrum, you have people that buy, 15 or 20 year leases. And then when they get close to 10 years, they sell them off. That's their policy. Buy 15 or more years, cash flow for a few years, sell it off. I've got a client that's a developer, a medical office developer. He builds these buildings for a specific medical tenant. He usually cash flows them for 3 years, and he hires me to sell them so that he can get some return back and provide a return. And those are all investment deals that he's essentially making, from what I understand, is syndication. So, it all depends on the asset. But, when I see people that are doing syndications, my friends that are big syndicators, they're typically, those holds are, 3 to 7 years typically. That's just, in general,
Yes.
that's what I'm seeing.
Yeah, I mean, it makes sense, especially with the syndication and needing to get returns out to investors. And a lot of times the debt is structured in such a way that there needs to be an exit before other terms kick in, 3, 5, 7 years, those types of things.
When we got into multifamily, that's what we learned, that for over 100 units and plus, they would like keep those assets, buy and hold them for 3 to 5 years.
Yeah.
And then we were kind of thinking, well, we would like to own something for a long time and expect that cash flow to come after many, many years. But it depends how you buy them, I guess.
Absolutely.
Yeah, and if you get the right debt structure on one of these, it sounds like it can be a cash cow for generations, right? And that's probably why people are hanging on to it. I think it paid off. All right. What are we not asking that we need to know?
I guess, my question is like, why are more of the people, on your side of the stage not running over to net lease? Because, especially in multifamily right now with everything that's gone on, there's just so much, there's a lot of opportunity in net lease. So I think that's the question a lot of people have to ask is like, where is the opportunity? And is this a space that I just haven't uncovered yet? I haven't, lifted up, whatever is covering it up, so I can get more information and more knowledge. I think that's, really, really important. And I guess, I just want to stress, over and over again, the importance of underwriting. Again, if anybody has a deal and they want to know what it's worth, or they want to sell, they can reach out to me. But if you have a deal you're looking at and you're thinking about buying, reach out, because, there's a lot of resources and information available, and people that are, happy to help along the journey, because it is a journey and it's a transition. Once you get it, you'll get it, right? But in the beginning, you want to make sure that you get to that stage successfully, and it's just so important.
Yeah, I think with the rise of a lot of syndication, or at least, I think it's gained in let's just call it popularity, but there's more and more people getting into syndications. We know some for vacant land, where they've entitled land and added value and just raise the capital that way. But also you have mobile home parks and multifamily. And I think there's there's been more of a capitalization on that type of asset class versus these leases. And I don't know why it isn't. But like I said, I mean, I'm familiar with it just because we traffic in the real estate world a bit more than others. And I've definitely heard, I would say in recent years, triple net leasing as a bit more, but it sounds like there's maybe more variety of types of properties, right? You have your single building, you have shopping centers, different types of tenants, and so I'm sure it's more. Not that multifamily is straightforward in terms of underwriting, but it sounds like these could be more complex, just with the leasing factor and how those are all factored in. But yeah, I mean, it sounds like just an amazing opportunity, and I'll say an untapped potential. Obviously, some people are tapping into it because they own all these properties. But it sounds like an attractive opportunity.
Yeah, it's very straightforward too. I mean, what you see is what you get for the most part, because I don't have to worry about pro formas. I can't stand pro formas. I don't really care about pro formas. I want to know actuals, right? And my actuals are baked into the lease. It tells me in my lease, what is my rent going to be today and what's it going to be every year for the next 20 years. So I really like that it's straightforward and there's not a lot of guesswork. And to me, it's like, if I see a pro forma, I'm just like, man, like, did the broker or owner just try to make this thing look good? Because I don't know if these numbers are real, versus like what I'm working with, these are actuals. Even if it's a shopping center, a good shopping center package, an offering memorandum will show you the actuals of the expenses and the rent and everything that's really going on, so you can make an accurate analysis based on real data.
Yeah, amen to that. That's the hardest thing to unravel, is what assumptions are being baked into pro formas, and are they founded in reality, or is somebody trying to dress up a pig and offload it, or what's going on there? Yeah, I'm with you. All right. Well, let's say somebody is interested in learning more and or reaching out. What are some of the good ways to get in touch with you?
So first of all, I'm very active on LinkedIn. I put out content pretty much every day, and you can reach out to me there or follow me there, or both. Obviously, my first name is Dan, last name is Lewkowicz, Lewkowicz. Again, Lewkowicz. Additionally, again, if you own property, if you want to know what it's worth, if you're looking to sell property or buy property, or if you just want to talk about real estate or get some eyes on a deal or, some feedback, please reach out. I'll give out my direct cell phone. It's 248-943-2838. Again, 248-943-2838. If there's anything I can do to help or add value, it would be my absolute pleasure.
That's great. Really, really good things. I definitely encourage people to reach out if it's anything of interest. Any final thoughts? Or
well, I really want to applaud you for one of the things that you said earlier, that you try to keep your personal investments clean and you keep your boundaries straight. And I think we have heard some horrible stories about the character of some brokers that have, their interest is kind of tied into the deals. And I think a lot of people and a lot of investors, and from the buying side and selling side, they want to know that they can trust the brokers, that the brokers have their best interest at heart. And I really want to applaud you for that.
Yeah, thank you very much.
Yeah, thank
you. It's hard enough to keep everything clear during the course of a deal, especially a high pressure deal, high stakes deal. And I've just thought so much about it. And
yes.
For me, it makes sense to be incentivized to work for my client and to keep that as my sole initiative. And that's just what, helps me to sleep well at night.
Right. And, obviously keep up the good work. I think that as an investor, we all want to invest in trustworthy deals and to make sure that our money is invested securely. Sure. And please spread the word, because I have never heard about this type of investments so far. So
yeah, it's good. It's always good to go in eyes wide open.
Yes.
Just no surprises or as few as possible. But well, I appreciate you coming on the show, Dan, and sharing at least opening Lygia's eyes to a new world of possibilities. Mine as well. And I think, a lot of people, I believe it's probably similar to me, something I've heard about. I just don't really know a whole lot about it, but, it makes sense. You see all these tenants as you drive around cities and towns, and they pay rent to somebody. And so, it's always good to be the landlord, especially if you're free of as many obligations as possible.
Oh yeah, absolutely. It's my pleasure. And I'll tell you, as a broker, the longer I do this, the harder it is to drive around cities, because the whole time I'm driving around, I'm like, oh my God, that's an amazing Panda. Oh my God, look at that building. Look at this egress. And it's just it's become my life to the extent that when I'm driving somewhere, that's what I'm most concerned about. I'm like, wow, that is incredible positioning. But I guess it's just how it goes.
Yeah. It comes with the territory. Yeah. I hear you. Well, we'll make sure and get your contact information in the show notes. Again, we appreciate your time and your expertise, and we'll look to hopefully have some more interaction in 2024.
Absolutely. Thank you both so much.
Yep. You too, Dan. Bye-bye. For those of you joining us today, we hope you enjoyed this time in the Champions Corner as much as we did. Got some awesome takeaways, and most importantly, will take action to continue living your best life and maximizing your potential. Mindset is such an important aspect of life, and when coupled with action, delivers undeniably powerful results.
Please subscribe to the podcast to hear from more great guests and get the latest mindset mastery insights and cash flow matchups.
Again, thank you so much for investing your time with us, and we look forward to seeing you next time on the Cash Flow Fight Club podcast.